2-point change, 17,890 is where the index is at. Just a few other names. I mean, maybe a few repetitions, but maybe something new. Adani Green did well yesterday. It's coming up as the top volume traded gainer on the across the board. So it's up about 3%, Adani Green. Siemens we mentioned. Sula was up big time yesterday. It's another 4.5%, 390. Mutual fund has bought a large block of shares yesterday. There is Just Dial, which is up 2.5%. 658 on Just Dial was up 10%. D-Mart is attempting a bit of a pullback. That's Avenue Supermarts, 1.33% higher on that one. HUL is up 1.25%. IRB, MRPL is up about 2.6%. There is Chennai Petro, which is up about 3% as well. So this is, a quick list of names which is higher. And Nykaa was the only name which was down sharply. We already mentioned that. It's down 4.5%. It was down yesterday as well. 134 on Nykaa, which is coming through. Zomato is down 1.25%. L&T Finance, I think, saw some moves yesterday, is down 1.5%. And Manappuram is down 3.5%. That's a meaningful cut at the word go, 118. And then names like Astral, which were under selling pressure. Astral is down another 1.5%. In trade. Varun Beverages has been all over the place. I mean, yesterday I think it recovered Friday's losses, but today it's down about 1.5% once again. So that's the market activity. 1:1 advanced decline ratio and 8-point change in the Nifty. So this is pretty much as flat as they come. Rahul Arora is Chief Executive Officer at Nirmal Bang Institutional Equities. He's joining us here in our studios. Rahul, great to have you with us here. Thank you very much. I noticed that you have your budget note out, right? The pre-budget note, and at that time of the year. So let's just start there. Any big expectations? And don't say the impact is come off every year, because that is what everyone starts by saying.
Everyone starts by saying it's merely a financial statement and it has no market implications. Is that what you're going to say?
No. First off, thank you for having me. But no, I don't think it's an. It matters. I don't think it doesn't matter. Let's get that out of the way.
Same thing in a different way.
Sorry. No, I think, I'll tell you why this is important, because this is a pre-election kind of a budget. So I think from a market standpoint, people will want to see what that fiscal deficit number is. Right, so we're at 6.4% for this year, and we've been estimating 6.2% for next year. Our own sense is that the budget itself may show a lower number to start off with, but as we've seen in this current financial year, the government has come back to take supplementary demands and rework subsidies. So it's very possible that as the year goes on, you probably have a little bit of an increase on fiscal deficit. I think we're assuming about an 11-12% kind of growth in tax revenues, which I don't think is out of whack. I think, the one reason why I'll say it's a non-event from a taxation standpoint is because all the indirect taxes have been subsumed into GST. So, I remember when, pre-GST used to literally go line by line, oh, check this, check that, but that's gone out of the way. I think it's just about whether the expenditure and the revenue adds up. The expenditure more so, Prashant, because this is a pre-election year. So if the rural part of the economy does not pick up after the winter harvest or even after the monsoon, then it'll be tricky to see how the government handles that in the run-up to the election. So, which is why we think they may show a slightly lower fiscal deficit number to start with, but they'll probably end up at about 6.2. I hope it doesn't slip too much beyond that. But all things considered, I think be prepared for a big bang year post-monsoons for government announcements and for government spending, which could benefit a lot of sectors. So I'd probably keep the tilt more towards domestic consumption and allied sectors. But well, let's wait and see.
Well, a lot of it has in any case happened, between budgets as well, right? A lot of the announcements. And you mentioned it in your report, the government has a very strong focus on making India a manufacturing hub, especially with what's happened with both Europe and China. So there's now India is looking to become an export hub as well, reduction of logistic costs. What are the announcements, A, that you're expecting in this budget, if at all, and B, from a market investor standpoint, what are the stocks that could benefit?
So, as you rightly pointed out, Sonia, I think this is an ongoing exercise. I think if you see the kind of product-linked investment schemes that have been announced, so the PLIs, it's pretty much cut through most of the sectors. So, I don't think they'll say too much by way of incremental that will encourage private sector, because our economist Teresa had put out a note recently which actually showed that government capex is trailing private sector capex. And you can cut across industries, right? Cement, I mean, take a look at Ultratech, see what SRF has announced, see what some of the auto component guys have announced. So, I think a lot of the private sector capex has already been announced. obviously, they're not going to come back to the market and announce it immediately. So it's going to be government spending that has to probably kick in and make up that deficit. But I think from a portfolio standpoint, if you're playing it off the budget, I'd say infrastructure. Right, I think you guys were highlighting Ashoka Buildcon. I think I could add a PNC Infra or KNR Construction, where the balance sheets are very good. The order book to bill ratios are about 3.5. As a second order beneficiary, cement, which will probably be our biggest overweight sector this year. You could look to play it through names like Ultratech in the large cap and down the market cap, something like a JK Cement. And as a third order beneficiary, because there'll be people who'll be working these projects, maybe consumers. So I think from a first order is the projects getting announced, second is what is used to make those projects, and the third is the wages that will probably result in consumption. So I'll probably say infra 1, cement 2, and maybe consumer 3.
All right. Hi, Rahul. Good to speak to you. Rahul, yesterday we had PVR. The stock got pulled back. There was a brokerage house that came in there, and they were sounding a little bit skittish. Maybe the content is questionable. I'll tell you what, a couple of regional films are doing pretty well out there. But what's your sense on this space? PVR, the stock has seen a sharp correction. We have that merger that's going to be going ahead, and it'll be a far bigger and far more dominant player.
So I think, Nigel, there's a business angle to it, obviously, and that's a bit of a concern because the only Bollywood movie, if you want to call it that, that's worked well, is also the remake of a South movie, which was Drishyam 2. So I think content is definitely a concern. We love the business. The operating leverage is phenomenal. But it's been a bit disturbing that India has opened up for almost a year now completely. And not one actor or one producer has been able to deliver a substantial Bollywood hit. So if the model is going to rely purely on regional or Hollywood, I don't think that's going to cut ice. So
yes.
That being said, in the immediate future, our valuations looking a bit stretched. I think they are. I think probably numbers will have to be reworked on the way down. But I wouldn't go so pessimistic as to say sell the stock because, the period between 2018-19, those 2 years, I remember there was a lot of good movies that came out from the late Irfan Khan, Ayushmann Khurrana, Ranveer Singh, and these were very, very big budget movies. They're getting anywhere between 100 to 300 crores. So it requires one seminal turning point. It could be Pathan. It could be, I'm saying, I don't know. But it's a great business. I mean, advertising margins at 95% gross, F&B margins at almost 75-80% gross. If your box office picks up, which is a 55-60% gross margin business, it'll flow through easily to the bottom line. So yes, there is genuine reason to be concerned, and I'll probably agree with some of the points that my peer has raised in downgrading their thought process. But I would say that structurally, it's a beautiful business. If you get it a little cheaper, 15-20% from here, I think it's a core portfolio hold for me. One of the best discretionary names.
If the ticket prices were also cheaper, I mean, I think it would. I think that would also solve some of the problem I mean, you'd be more forgiving, right? I mean, the movie is not, but prices are prohibitive in some cases, right? So that also makes a difference. I mean, we can go on and on. Right? There's no end to this.
Yeah.
I want to ask you about retail, right? Which is D-Mart, Avenue Supermarts. I mean, something that you have spoken about in the past. What's your view? Yesterday, again, I mean, that one sold off.
I think, Prashant, most parts of the market are priced to perfection. And I think you need a serious beat on results now for people to re-rate on the way up. People will take a good result in their stride, as you're seeing with the case of Federal Bank. But I think when you're talking about the kind of valuations that you are for D-Mart, I think it's to be viewed in context of an HDFC Bank. There is a certain growth rate that you have to deliver to command these valuations. Beyond a point, people will not. And HDFC Bank went through its process of consolidation as well. So there's no reason to suggest that D-Mart wouldn't. It's, again, a fantastic franchise. It's not something that is easily broken in the back of competitive intensity. I think they've worked the ground. But much like a Lever or a Reliance or an HDFC Bank went through multi-year consolidation, I think people have come to expect that a 25-30% compounding is what D-Mart will have to deliver. And I think if that's something that they don't do, they'll have to keep fighting for that valuation space with other retail players as well. And when I say retail, I can probably extend that to QSR as well. And maybe to in some levels to even auto. So I think, when you're talking about consumption, you take the whole basket. A 20% growth on D-Mart with these valuations, unfortunately, I don't think will cut it.
Okay, I guess that's what the street is concerned about as well. What about IT? Is it a good time to be buying? The month of Jan has been good so far. The index itself is up over 2%. Are you buying now?
Not yet, because I think barring HCL Tech, a a month back, nobody's really called out anything in terms of a red signal so far. Our own sense is that if the US and the European region goes into a slowdown/recession, and you have China that probably goes into maybe 2-3 years of sub 5% kind of growth, it's going to be a little challenging to get your top line growth. So our head of research, Girish, has put out his note where I don't think he's expecting more than a 6-7% growth in the top line for IT companies next year. And I don't think he's even talking about a double-digit growth in the bottom line. That being said, I think a 26, 27 times for TCS Infosys, there could be a better entry point. Something like a Mindtree and a Persistent is going even more expensive than that. I think one thing, Sonia, that people have to keep in mind is that the outperformance of IT was so stark when COVID started. I mean, Persistent, as a case in point, went up 7x. It didn't move in percentages, right? So technically, even from the high, if you lose 50-60%, if you bought it at the right time, you're so amazingly in the money that, you know, but we have a habit of saying, upar se kitna chhoot gaya. We don't see how far you've come from the bottom. But I think the time will come. I think there is a case for the companies will probably have a little more visibility after Q4 earnings, because I think the interest rate hikes will probably still be feeding into the system. And I think the one thing, Sonia, that's a challenge for banks globally is deposit growth, right? You're seeing deposit rates rise across the system, which will put pressure on net interest margins. If that happens, almost 35-40% of the revenues for Indian IT companies comes from BFSI. You're seeing layoffs in the BFSI sector. Goldman Sachs, Morgan Stanley, globally have all announced layoffs. So there is cost cutting. So I'm not saying that these TCV will not convert to revenue, but there is nothing stopping the client from saying, okay, I'll probably move this contract by 6 months to a year, which then does not show up in revenues that financial year. And then obviously, because you had this challenge of moonlighting not too long back, you probably have a slight upward pressure on wages. So if you were giving a 5-7% hike on fixed, that probably moves up to about 8-10%. So if you have a compressed top line and maybe some costs rising, I think there is a case for valuations to correct by another 15-20%. Fantastic sector, Sonia. There's no question. I think that this and FMCG are the only two sectors that have the kind of cash on books, the dividend and free cash flow yields. So structurally, nothing wrong. But everything at a price, and maybe after Q4 results would be the good time to be buying into the sector.
Okay, all right. Very quickly, Rahul, before we let you go, the new age themes looked interesting enough for you all to be positive on them, or you still give them a pass?
You know, I remember we had this chat before the 2020 World Cup and FIFA started, and I was very bullish on Zomato, and I thought it would probably head to 75-80 by now, but that hasn't happened.
Yes.
And I'm pretty sure they're going to have a record quarter because of the kind of deliveries that they've done.
Yeah.
But I think, Nigel, if you see the kind of IPOs that came out in the first leg of COVID and compare them to most of the IPOs in 2022, there's a marked shift in the kind of companies that are coming out with their IPOs. I think you've moved from loss-making to profit-making, and people have moved away from talking about price to sales to back to return on equity and capital employed and price to earnings. In that trade-off, when liquidity is withdrawing, I think these guys will find it a little difficult to make a push. But let me reiterate, I think if these guys are able to demonstrate a road to profitability and cash flows, it's not necessary that they have to report it in this year or the next year. But if the burn is coming down and the market visibly sees that, I think they'll be rewarded. I think the prices are very, very attractive right now in all of these new generation companies. They just have to go back to the basics on focusing on cash flows and talking about return ratios. And I think the market will probably, they want to give them the benefit of doubt. They just want to see a little bit of delivery before they do.
Okay, investors live in hope, right?
Always.
But do you track defense by any chance? Because we have a conversation lined up with HAL. Is that a stock that you like?
Not looked at it, honestly, Sonia. I think through Bharat Forge, maybe, but never as a standalone
Maybe you'd want to then listen into the conversation. Rahul, thanks a lot for
Thank you so
joining in. Have a great 2023. Well, the Indian Army has ordered nearly 2,000 unmanned aerial